Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And in this webcast series, we talk about using options for income. And I think that I can say fairly confidently, a lot of income investors and traders out there are fairly conservative by nature. But today, I want to talk about why some investors and traders get pretty excited when things get choppier with the markets. How is it that volatility might benefit an income trader? And specifically, we're going to be framing that within the context of doing an example covered call trade. So I think this is going to be a great discussion. We're going to be weighing how premiums are impacted by volatility, the pros and the cons of seeking income in more volatile market conditions. So a lot to cover, but before we get to that, though, let me first of all say hello to everybody that's already chatting in out there in YouTube. I see a lot of familiar names. I see a lot of newcomers as well. So hello there, Rice Bird and Mighty Mouse, Life in the Fast Lane, John, Lawrence, Will, Eva, Hope. Hello, good to have you here, Andrew. Everybody else. Dom, thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you are among those that are here for the first time, I want to welcome you as well. I hope you'll make it part of your schedule to either join the live streams or to watch the archives of these sessions. If you're watching on those archives, though, I also want to issue an invitation to you. Join us here in the live stream. We'd love to have you here as a live audience member. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, finally, I want to let everybody know that you're certainly, if you have an account on X, you're invited to join me there on X. Follow me on X. It's the best place to connect with me in between these live streams. You can find me there on X at Cameron May CS. When I'm not doing a live stream, I'm frequently checking in on X. I'll post there when I see something pop up in the markets that I think is interesting. Might even just give you an update on my weekend. But when you reply to one of my posts on X, I try to reply right back to you. So really, it's the very, very best place to connect with me in between these live streams. But let's get into this discussion. Of course, we need to first of all recognize that trading and investing carry risks. This is important information. Please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-trading account is solely your responsibility. All right, so let's outline an agenda for what we're going to be spending our time today on. First thing that we're going to do is take a quick peek at what's going on with the stock market. Nice rally today off of last Friday's sell-off. Then we're going to turn our attention to our existing positions in our example portfolio. And it was some of those positions that kind of spurred today's thought processes. I was looking at maybe selling a new call on some positions, but I recognize also the markets have been moving around quite a bit. And yet for some income investors, that might be just what they're looking for. Additional volatility, as counterintuitive as that is, there can be potential benefits to the income investor when markets get a little bit choppy. So we're going to use our current trades as the sort of backdrop to discuss the pros and cons of choppy markets for income traders. And then we're going to go place a new example trade or two today. All right, so let's go right to our Thinkorswim desktop platform. Now, if you are new, you need to be aware that very commonly our demonstrations here are done on what's called Thinkorswim desktop. This is a software platform that can be downloaded from within your Schwab Online account. You would just go to the Trade tab within your Schwab Online account, and right there on that tab, just look for the keyword Thinkorswim, and you can just click on that, and it'll walk you through the process of downloading this software. It doesn't cost anything to download the software. And you just log into it using your Schwab username and password. Same credentials. But this gets us into the platform. One of the big benefits of this platform is that, well, it allows us to access our live portfolios if we want to actually manage real balances. But also, there's a mock-up or a practice version of the platform. It's called Thinkorswim Paper Money. And you'll notice up here in the upper left-hand corner, mine says this is simulated trading. So everything that we're going to be doing today is all for learning. And fortunately, no money at risk. This is a great feature of Thinkorswim. It allows us to just learn in a no risk environment. But right now we have 8 positions. We have some covered calls. We have some short puts. Before we get to those positions, though, I promised you we're going to go have a look at the market. So let's go see what's going on with the S&P 500. And so just looking at this from a technical point of view, and maybe let's put ourselves in the shoes of an income investor or trader who's maybe looking out to possibly even the September options expiration cycle, September 19th, to plan and place a new income-oriented option trade. First thing that trader might do is have a look at something like the S&P 500 to get a general gauge for, is this a decent market environment? Does it appear to be a market environment for seeking income through bullish strategies like covered calls and short puts? And really, this has been quite a cooperative market for covered calls and puts traders over the last about the last 4 months. Obviously, these 2 months, not so good. Yeah. But as markets climb, that can lend itself very nicely to approaches like covered calls and short puts, which do benefit from rising market prices. Now, this is the volatility I wanted to talk about today. I don't think that very many people in this audience are going to be caught off guard by the fact that markets have seen some increase in volatility over the last week or so. You can see the size of the candles has gotten larger. This overnight gap was a big move very recently. And that sort of thing can sometimes cause an income trader to kind of pump the brakes. I don't like this kind of volatility. However, it may actually attract other income investors because it may present relatively short-term windows of opportunity for enhanced income potential. Now, I don't want to sound like it's a sales pitch for income strategies. We definitely need to weigh the pros and the cons, but it is a fact that higher movement in stock prices can lead to higher premiums from options. But just looking back at the chart of the S&P 500, though, let's say that our hypothetical income trader sees that price has been going up. We've had this recent sell-off. It's interesting, though, that it's taken us right down to about that 6,200 level on the S&P. And that's just above previous highs from back in December, January, February, and almost moving into March. So that old price ceiling appears to possibly be lining up as a new price floor. And let's just say that leads our would-be income investor to conclude maybe their conviction going out into the near-term future is that prices are more likely to rise than to fall. Now, obviously, we don't know for sure. We could move here into late summer and into the fall and things start to pull back. That can definitely happen. But let's just say that that's our technical perspective. That's our outlook. Time will tell us whether it proves to be right or wrong. But let's now let's go give some attention to our existing positions. Now, as I do this, I'm going to go to the monitor tab. We have 8 positions. Most of you, because I'm seeing 534 people watching the live stream right now, I'd suspect that a lot of those in the live attendance right now didn't get to see us as we placed these other trades. So I want to make you aware of some resources that are available to you outside of just these live streams. So glad to have you here in the live stream, but be aware of these resources. Make sure you're taking advantage of them. Number one is, if you haven't subscribed to our Trader Talks channel on YouTube yet, do it right now. It doesn't cost anything. It literally only takes a second. To subscribe, you just look down in the lower right-hand corner of your screen and click on that subscribe button, or you can go down below the video stream and just click subscribe. So if you haven't done that already, do that now. But the YouTube channel is where we house all of our previous webcasts. So if you weren't here for the live stream, you're wondering, hey, where do we find these if I wasn't able to watch this thing live? This is where it's found. So you'd go to YouTube and find our channel. Trader Talks Schwab Coaching Webcasts is the channel name. You can just search for it. And then you can find the previous webcasts under the playlist right there from our channel homepage. So for example, if I were looking for this webcast series, Trading Covered Calls and Short Puts, I'd go to playlists, and here are all these different webcast series that we have going on. I'm going to scroll all the way down, This one happens to be closer to the bottom, about 4 rows up from the bottom. So we'll go to the bottom and go up a little bit. There it is, trading covered calls and short puts. There's your presenter's mug. That was back when I had a little bit darker beard. Anyway, but I'm going to click view full playlist. And there are the previous webcasts where we set up these example trades. So that's one thing I wanted to make you aware of. The second thing is that if you haven't done it already, I mentioned, follow us on X. You can follow me on X at Cameron May CS. Also, we're joined today in the chats by my very good friend and long-time peer, his name Ben Watson. Ben and I have now been working together in an educational capacity for more than 20 years, if you can believe that. You can find Ben here at Ben Watson CS on X. But yeah, this is where you can interact with me or Ben in between the live streams. So for example, I posted just this morning a little poll. I wanted to know what my followers have to say on this topic. If anything's going to derail stocks in the near term, what do you think it will be the most likely culprit? Is it going to be tariffs or earnings or Federal Reserve actions, or is it going to be something else? And then when you reply to me, I just try to reply right back to you. Okay, so there are other resources there. But going back here to our example positions, now that you'll know how to see the logic of when those trades were taken, I wanted to call our attention to two for today's discussion. Right now, we have some shares of just Apple. Notice on the Thinkorswim paper money here, it says Apple, we own 100 shares. Well, this isn't called, the webcast series isn't called Investing in Stocks. It's covered calls and short puts. So we're going to be selling a call against this Apple position. And we're going to be doing the same thing with our Visa position right down here. We own 100 shares of stock. Noodlebrain says, and by the way, that's a great name. Do you have any videos on how to buy calls and puts as a day trade or a swing trade, how to choose a stock, how to analyze when's a good time to buy, all that sort of a thing? It sounds like you might be that would be very technical, analysis oriented. And yeah, here's what I would suggest. If we go to the channel, if you have an interest in, let's say, swing trading, let's type in swing. And what you'll find here is all sorts of all sorts of videos specific to that approach. So for example, here's one that I did, swing trading stocks with something known as the volume profile chart tool. So yeah, that's one of the benefits of being a subscriber to the channel and finding that channel homepage on YouTube. All right, but great question. Let's go back to our positions. And I want to look at Apple. Let's go through a quick history of our Apple position. These other positions, I'm not going to do a lot with these today. They're generally doing fine. Apple is one position not doing so well. So here's what's been going on with Apple. If you've been following this webcast series at all along the way, it's great. If not, I've written the details of the history of our Apple position. This is the one that's given us some serious lumps this year. But initially, we started this off in what's called a wheel strategy position. We sold a put back here, initiated this trade. This was March 3rd. We sold a put that was ultimately assigned. Sold the 235 put, collected a $3 premium. That became a realized profit when that contract was assigned. But we were assigned the shares at 235 bucks. So if we own the shares at 235, look where the shares are right now. They're at 203. Yeah, shares have really taken a beating. They've been in somewhat recovery mode, but along the way, we've been selling calls against that stock position as covered calls. So we have that realized gain on our initial put, sold a call here for an 80-cent profit, sold a call here for a 149 profit, a call here for 225, a call here for 165, a call here for 133. We had an earnings announcement coming up, so we didn't hold this. We didn't have a short call position against the stock through that earnings. Didn't want to put a cap on the upside. Now, a potential detriment of making that sort of a decision is if the stock happens to go down, we don't have anything really to help us absorb some of those losses. but we just held the stock through the earnings. Stock has fallen. So here's where we are right now. If we are assigned the shares at $235 and we just held on to them to today, we'd be down about $32. However, collecting these premiums has helped us absorb some of that impact. It's lowered the break-even point for our trade down to $224.48. That's just a quick history. Bottom line is now we just own stock. And as shareholders, we now may choose to sell into a new covered call position where we're entering into a contract, giving someone else the right to buy our shares from us for a fixed price for a fixed period of time, but in exchange, collecting a potential income. But for some traders, Noodle Brand says, wouldn't you have added a stop loss to avoid that 235 to 203? Some traders certainly do. Yeah, and we do that. We explore different ways to manage trades. That's a great question. What you'll notice is as you watch these webcasts, we'll manage some trades one way, we'll manage some trades another way, just to weigh the pros and the cons. But I will say, those who watch my video series know I took about a month off, went to Scotland right here. Not the best time to do it. But in any case, yeah, it is possible to just put a stop in place on a covered call. And if the stock really starts to misbehave, maybe we sell those shares. Stop isn't a guarantee that we'll sell at a specific price, but it can theoretically help to manage the downside of a trade. But also, if we get stopped out, sometimes the stock rallies and we get left in the dust on that rally. So, yeah, legitimate question. And we will do that on some trades in the future. But in any case, here we find ourselves with the ownership of shares. And in the spirit of seeking income, which is the point of this webcast series, some traders will pause before they put on a new income options trade and think, yeah, but whoa, Cameron, these markets are just so choppy. That volatility just makes me scared. Okay, that's relatable. But I also want to talk about the potential benefits to the income investor or the income trader that can come right along with higher volatility. So let's go let's go take a look at what's been going on with volatility just of the markets overall. And then we're going to come back and we're going to put on a covered call on this stock position. But I want to get a gauge of just how volatile stocks really seem to be at the moment. What is a chart that a trader might use if they want to gauge not the direction of stocks, but the volatility of stocks? In that case, we might use something known as the VIX, or the volatility index of the S&P 500. So this looks mostly like a normal stock or a normal stock index. However, this is actually charting expected volatility over the next 30 days for S&P options traders, basically. Sometimes when traders expect a ton of volatility, we'll see a spike in this chart. At other times when traders expect very low volatility, we'll see this chart drop to lows. And you can see it's been as low as all the way down here on the scale over to the right. We get down there around 13, 14. PG says, what screen are you looking at? This is actually known as Thinkorswim Desktop. It's software. I mentioned how it can be downloaded a little bit earlier in this webcast. But yeah, it's called Thinkorswim. You can download it from your Schwab Online account for free. All right. But this is just a basic volatility chart. It's expected volatility for the S&P 500 over the next 30 days. And that can have important implications for the pricing of options. There tends to be a very strong correlation between the movements of this chart and the movement of the pricing of options. And what covered call traders, income traders, and what short put traders will notice over time is that sometimes it seems like, boy, we get really big premiums when we sell options. And other times, oh, geez, these premiums just don't seem to be very juicy. This chart can provide some significant insights into that. So when volatility is high, typically options premiums go up. And for our would-be income investor, our income trader, that might mean that if they were to sell options at that time, they may get bigger premiums than at other times. Why do premiums go up as volatility goes up? Well, let's look right back here to April, early part of April. First week, second week of April, the stock market was just moving extremely rapidly. And when the market is moving really rapidly, option speculators see that as potential. Boy, if I bought some calls and the markets went really rapidly upward, I could make a lot of money. If I bought some puts and the markets went really rapidly downward, I could theoretically make a lot of money. So when markets are currently moving rapidly or expected to move rapidly, and this is really a projection of expectations as much as it is what's happening right now, the speculators in the options market will tend to drive up demand. They'll buy more calls, they'll buy more puts, they'll do other more speculative strategies. But at the same time, there can be an increase of demand from options hedgers as well. Some people are here in the options market for entirely different reasons. They're here to hedge the risk of maybe stock portfolios. And when markets are moving rapidly, our hedge traders can see that as risk. And that can drive up the demand from hedgers. Maybe they buy puts to offset some risk in their portfolio, as an example again. But yeah, when volatility is high, there tends to be high demand for options and prices go up. So for option sellers who are looking to sell, most sellers of whatever, houses or cars or collectibles or whatever, options, when they see spikes in prices, they may describe that as a seller's market. So yes, when we see spikes on this index, some traders will describe that as a seller's market. Options prices are comparatively higher. And this one I'm using as sort of the extreme example, but even more recently, there can be fluctuations even within a quote unquote normal range. And you can see over the last 48, 72 hours, our volatility spiked up and got up to the highs that are more representative of more normalized highs over the last 12 months. So for someone who's maybe wondering, well, are premiums relatively high or relatively low right now? Over the last 48, 72 hours, there's been a window that has opened where premiums are a little bit higher. So yeah, Kelly says maybe sell on higher volatility. Yeah, when the volatility chart drops, that's frequently described as more of an options buyer's market, because options prices are pretty low compared to where they have been historically. But I wanted to show this chart because I can relate to that new options trader who might be going to sell a covered call, and they might look at that and say, wait a minute, I would swear last month I was getting more from my covered call than I'm getting this month. What's going on? Well, it can directly relate to this market condition. Now, it can also relate to the individual stock. Let me throw out a question for you. If we're about to sell a covered call, I'm going to be selling a call on Apple, I'm going to be selling a call on Visa. Are Apple's premiums higher or lower than normal? What we've been looking at is just premiums overall. That VIX chart can give us a general gauge. It's kind of like looking at the S&P 500, and if the trend is up, we know that for most stocks, probably their trends are up as well, but not for every stock. There are certainly going to be some stocks where the trend is down. When we look at the VIX, it tells us that generally, when there's high VIX, there's going to be high premiums on most stocks, but not on all of them. So if we get more specific, if I say, I wonder how the premiums are on Apple as we're about to go place a covered call, how might we know more precisely to the individual stock whether premiums are high or low? A couple of ways that we could do that. Let me give you another tool. This is going to be specific to Apple. Let's bring up Apple on our chart. And I'm going to add an indicator using our little flask icon up here at the top. Jarish says Apple premiums will be higher because it's a volatile stock. Well, if we were to compare, really want to make a pun about apples to something else, but yeah, if we're comparing Apple to some other stock. All right, anyway. It may be accurate to say that Apple's premiums are higher than the other stocks' premiums, maybe because Apple is more, let's say, just inherently volatile at any given time. than our other mystery stock. But what about Apple's premiums right now compared to maybe Apple's premiums historically? What do we think? Would you say that Apple's premiums, not compared to some other stock, but compared to Apple's premiums in the past, are they high or low? I'm going to say they're relatively low right now. We need to be prepared for that. All right, let's go have a look at why. I'm going to click on the little flask icon, and I'm going to use an indicator known as implied volatility. IV is basically, it's very much like the VIX chart, but for the individual stock instead of just the market in general. So I'm going to choose implied volatility from our list of studies here. Let's add it to our chart and click apply and click OK. And what we're left with here is this green line down below. It's going to oscillate between highs and lows. It's just going sideways generally. But this is really telling us whether Apple premiums are relatively high or relatively low to where they've been over the last 12 months. So if you look at where it is right now, if I were to draw a line backward, you'll see that most of the time, this indicator has been, well, I wouldn't even say most of the time. It's certainly been much higher than it is right now, right? They actually spiked way up back here in April when things got really exciting for the markets. Did that apply to Apple as well? Yes. Apple's options were quite pricey back then. And options premium sellers might have just felt like, boy, I'm just getting paid a ton of money right now compared to maybe early December. Apple's premiums, that's when the premiums were the lowest. So this is just a reflection of expected volatility for Apple. And it's a pretty good gauge of how options are priced generally as well. So if I look at this right now, it's nowhere near the highest point. It's not too far off the lowest point. I would say it's probably, if we were to say this was 0 and this is 100 up here, just as a range of total implied volatility over the last 12 months, you might say this is kind of about the 20th percentile. Does that make sense? It's not anywhere near 100, closer to 0, about the 20th percentile if we're just looking at the range of total premiums available for over the last 12 months. There's another way that we can see that. Instead of visually, we can see that by going to our trade tab. And I'm going to go right down to the bottom of the option chain to something called today's option statistics. So we go to the trade tab, we make sure that we're looking at Apple, and we look down here at option statistics, and I can see the range in volatility for Apple over the last 52 weeks. It had a high of 71%, a low of 18%, and it's currently about 29%. So yeah, so we're much closer to 18 than to 71. Right now, we are at the 21st percentile for implied volatility. So what this is telling me as a covered call trader is, all right, I probably need to be prepared for the fact that my premiums aren't going to be as juicy as they were back in April. Let's talk about the pros and the cons of selling when we're getting something like this. Oh boy, if we got a high implied volatility like that, literally that translates to very high premiums on Apple's options. Lots of income available back there compared to right now. So what are the pros? Let's go through the pros of selling premiums when volatility is high, but then we also need to balance that out with the cons, and then we'll go ahead and place this covered call trade. And let me see, probability trader. Oh, you're asking a question of Ben. Okay, I'll let Ben address that. Anyway, but let's put ourselves in the shoes of the covered call traders back here in April. And they're looking at the covered call traders today and they're saying, oh, you poor suckers, you're not getting anywhere near the income that we are back here. When there are spikes in volatility, as I've already discussed, premiums can go up and they can go way up. Okay, maybe I'm going to illustrate that using a calculator in just a moment. But let's just talk about it conceptually for just a moment. Premiums were much higher back in April than they are right now. Well, that's one advantage. On a day-to-day basis, the income available from selling covered calls was higher. I was about to say better. Better's, ooh, that's a tricky word, but higher back in April. So that's one pro. A second potential pro is that if premiums are really high, the trader can actually go what we call further out of the money. Let me just illustrate that. How about we start to build our covered call trade right now? Let's go maybe to the 19th of September. I'm just going to use that as our example expiration. I'm not going to spend a lot of time explaining, which expiration a trader might choose. We sometimes go through that in great detail. I just wanted to talk about premiums in general today. So let's go to the 19th of September. That's the time frame that we've been talking about since the start. And tying this to the chart of Apple, let's see. Our break-even point on this trade is all the way up here at 224.48. We're down here at 204. What if we were to sell, let's say, the 225 call? That's going to be up here. Let's draw a line from today. I'm going to draw it just above my break-even point, but that's just intended to represent 225. And actually, let's right-click on that, edit the properties of that trend line. Let's extend that out through September 19th. There we go. Let's just envision that we're selling that 225 call. Well, that's a long way above the current stock price. That is way out of the money. And if we go to that, look at that on our trade tab, it's not a lot of money. $1.16, $1.17 appears to be about that premium. That's what it is today. When there are really high premiums, what do you suppose this might have been with much higher volatility levels? This is where we might use a tool here on Thinkorswim. I don't have to talk in hypotheticals. I can actually use a calculator and figure that out. Let's say, let's put ourselves back in the shoes of our April traders. I'm going to click on this Theo Price tool right up here. Now, what we're going to be looking at here is this column here that says Theo Price. If it's not one of the default columns on your platform, you can actually just click on a column heading. So for mine, for example, this morning it was Gamma. So I came over here to Gamma, I clicked on that heading, and I switched that to Theo Price. And what this does is it gives us access to a calculator that lets us put in some hypotheticals like, boy, I wonder, what if our volatility were 15% higher than it is today? And now it's at 29. What if it was more? Let's say it was closer to 45. We put in 15%. We've seen it's been actually as high as 71% just this year. Let's say our volatility is higher. Looking at our 225 strike, right now we can only collect about $1 on that. With higher volatility, maybe $4. That's about 3 times as much. It's actually closer to 4, about 3.5 times as much premium available because of a spike in volatility. If there's high volatility like that, our trader might even decide to go further up in price. So yes, higher premiums, that's one potential advantage. A second potential advantage of these high volatility environments is that our trader might be able to go further away from the current price. So maybe instead of selling the 225, maybe we sell the 230 or the 235 or the 240. In highly volatile markets, it's likely that there's going to be a quote unquote acceptable premium for our trader to sell that far away. So there's 2 potential benefits. What's a third potential benefit? Well, if you look at our chart again of this volatility spike we had back in April, what happened with that volatility quite rapidly right after that? Volatility dropped. With that falling volatility, what does that do to options premiums? Options premiums drop. So if our trader had the timing, if we had the timing to sell when those premiums were really high, and then the volatility drops, that can actually accelerate the profitability of the trade. Falling volatility means that maybe not so much demand from speculators, maybe not so much demand from hedgers, the price of the options drops, and that can actually accelerate that trader toward a profitable exit on their covered call. Jerish asked a great question. What is an acceptable premium? You notice I put that in air quotes a little bit earlier. Acceptable is going to vary from one trader to the next. There are going to be some who look at this. These are just current conditions. They may look at this and say, well, $115, selling that 225 strike, that's not bad. Right now, it's about 0.5% of the current price of the stock. And to them, that might be just fine. For others, though, they might say, you know what, I need a little bit more premium. Maybe I need to sell a little bit closer to the current price of the stock. Maybe instead of selling the 225 call, I sell the 220 call. That's getting me close to double the premium, but I'd have to be selling something like down here, where I have the obligation to maybe sell our shares at 220 instead of 225, if those shares happen to rally. There we go. So it's a good question, Jerish. I can't answer it definitively for every trader out there. They just have to weigh the pros and cons. Bigger premium, but getting into a contract where we might have to sell our shares at a lower price than 225. All right, so higher premiums, we can sell potentially further out of the money with these when we have a spike in volatility. Falling volatility can potentially accelerate profits. Sounded like this, boy, Cameron, you're making a great case for selling during high volatility environments. And right now it looks terrible. Why would I sell right now? Well, there are cons to selling in a high volatility environment. You probably know what they are intuitively. What are some of the potential risks of selling options for income in highly volatile environments? Just use April to put an exclamation point on some of these risks. Oh, when we're selling in highly volatile environments, stocks are moving around a lot. That is the definition of volatility. And when there is movement like that, there is a strong risk as owners of the shares of stock that we might, if while we're holding on to those shares, waiting for expiration on our contract, this can happen. Stock can fall. That can cost us in unrealized losses pretty quickly. There is increased market risk during highly volatile environments. That's just kind of intuitive. Also, it's quite common that high premiums are associated with things like earnings announcements, with other news announcements that are scheduled. So if we're just pursuing high premiums blindly, it may lead us to taking risky positions like selling calls right before an earnings, selling calls right before a lawsuit is settled, not settled, but a lawsuit verdict comes out, or some pending legislation that could strongly influence the stock that we weren't aware of. Just be aware that the premiums are commonly associated with risky pending events. There's also a stronger risk of assignment. If we don't want to sell the shares, that increased volatility could put that stock well in the money and increase the likelihood of assignment. If the trader's trying to avoid that, might be that they want to pump the brakes, even when premiums appear to be pretty saucy. Now, a final thing is, just because volatility is high and we think it's going to go down, it could keep going up. And if volatility continues to climb, that can actually make it more expensive to try to close out of these covered calls. So there are pros and cons to these approaches. What we're going to be doing today, let's go with the original plan here. I'm going to sell a call up there at 225. Let's go to our trade tab. Let's go to the 19th of September and sell this 225 call. And to do that, what we need to do is just make sure that we're in the same account where we own the shares. And we go to the 225 strike on our option chain and click on the bid price. And we need to make sure it's the correct number of shares. So in this account, if we go to our monitor tab, we own 100 shares. So that's one contract that we're going to sell. Selling one Apple 19th of September 225 call, looking to try to collect about $1.14 per share. Let's say that we're even willing to accept, just for today's example, let's say $1.10 per share. Let's set that as our limit. And I'm going to click confirm and send. Going to sell that 19th of September, trying to get $1.10. for that 225 call. It gives us a max profit, a max loss. This max loss, we don't want to worry about that. It is there. If we were to do a naked call here, there would be infinite risk. This isn't a naked call. This is a covered call. We own the shares. But one thing that does apply is there's a commission to be paid here that can chip into this credit a bit. In a case where we're looking for a minimum acceptable credit of $109.35, let's send that off and see if we can get that filled. Now, a take-home message here is maybe we move over to our Visa position is we are settling for a lower premium. It's a lower premium environment for Apple specifically, but there are trade-offs there as well. When we're selling premiums in a lower premium environment, a lower volatility environment, some of the cons from high volatility environments can become sort of the pros. In any case, looks like we just collected about a 110 premium there. So let's go to our Visa position. We own 100 shares here as well. So if we go to our trade tab, how about take a quick look at Visa? That's trading, looks like a recent ceiling on Visa, right up here around 355-ish. What we get for a 355 call for the 19th of September looks like maybe 435, 455. We go up to 360, maybe 296 to 310. How about we do that one? That would be selling a call up here at 360, just above those recent price ceilings. I'm going to click on that bid price, and let's sell one contract there. Let's say we're willing to settle for $295. Click confirm and send, selling that 360 call for $295. There is a commission to be considered here, meaning our minimum acceptable credit for this trade is going to be $294, and we're going to send that order off and see if we can get that to fill. In any case, we've accomplished what we set out to do today. For some of you, this could have been a little bit of heavy lifting. Fortunately, we can go back and rewatch these webcasts. If you just want to go back and process it a little more slowly, our webcasts are recorded and archived. So as we wrap this up, I'm going to make you aware of some other resources you have, including where to find those archives. But we've accomplished what we set out to do today. I wanted to take a quick look at the markets and see what's happening there. I wanted to talk through the pros and the cons of selling covered calls in a more volatile market environment. So hopefully you found a good balanced discussion there. And then we placed our example trade. But yeah, here's where you can find those archives. So first thing I would suggest, as I suggested it before, is if you haven't subscribed to our Trader Talks channel, do that right now. You can go down the lower right-hand corner, click on the subscribe button. It literally only takes a second. It doesn't cost anything. But our YouTube channel is where we post our previous webcasts. So you'd go to YouTube, find Trader Talks Schwab Coaching Webcasts, and then go to playlists, and you can find the playlist for our different webcast series there. You can also join our live streams right here, or if you have an interest in something specifically, maybe you want to brush up more on your covered calls knowledge, you can just do a keyword search. Type in covered calls, and there we go. You'll find all sorts of archives relating to covered calls. All right, now a second resource that I want to make you all aware of is you can follow us on X. If you have an account there on that platform, it really is the very best place to connect with me and with Ben in between these live sessions. You can find Ben on X at Ben Watson CS. You can find me on X at Cameron May CS, and do be precise with that. There are lots of similar sounding handles on social media. So just make sure it's at Cameron May CS. But this is the best place to see what I see what's going on with the markets. You can reply to me, and if you reply to me, I try to reply right back to you. So everybody, thanks for joining today. Definitely appreciated it. I saw about 100, what do we have? About 500 people watching right now, and I can see 83 have already clicked that thumbs up. Thank you for doing that. A thumbs up is your final applause to your presenter for a job well done. If you enjoy one of our webcasts, make sure that you always click that thumbs up. Not only does it make us feel good, but it also gives us a boost in the YouTube algorithm, helps more people find discussions like this. All right, guys, I will see you next week for another discussion of covered calls and short puts. Also, I have other webcasts every day of the week until then. So I'll look for you in those other webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.